Which real estate leading indicators should novice investors look for in market cycle analysis? Imagine trying to predict the next big move in real estate without a crystal ball. The key is spotting early signs that tell you where the market is headed. For new investors, understanding these signals can make a huge difference in timing your investments. Let's explore the main indicators that can help you read the market's mood and plan smarter. First, look at vacancy rates. This tells you what percentage of rental properties are empty. If vacancy rates are climbing, it could mean demand is dropping and the market might be heading into a slowdown. On the other hand, if vacancy rates are falling, it shows more tenants are looking for places, which is a good sign of a strengthening market. When vacancy rates start to stabilize or decline after a peak, it often signals a good time to buy because prices may be low and demand is picking up. Next, pay attention to rental rates. Rising rents usually happen during the expansion phase when demand outpaces supply. If rents are steady or climbing, it suggests the market is healthy and properties can generate good cash flow. Falling rents might warn you that supply is outstripping demand and prices could soon drop. Monitoring new construction activity is also important. When builders are not starting many new projects, it can mean they are cautious and the market might be recovering or stabilizing. If there's a lot of new construction, it shows confidence but can also lead to oversupply, which might push prices down later. Absorption rates tell you how quickly properties are leased or sold. A high absorption rate during an expansion indicates strong demand, while a slowdown could mean the market is peaking or oversupply is on the horizon. It's a good way to see how hot or cold the market really is. Economic factors like employment growth and overall economic health are vital. When local jobs are increasing, people need homes and commercial spaces, which supports market growth. If employment stalls or declines, demand can weaken, signaling caution. Interest rates and borrowing conditions also influence the market. Lower interest rates make borrowing cheaper, encouraging more buying and development. When rates rise, borrowing becomes more expensive, which can slow down demand and investment. Finally, observe property price trends and returns. If prices are rising rapidly, it might be a peak. When prices bottom out and fundamentals improve, it could be a good time to buy. Watching these trends helps you avoid buying at the top or selling too early. For beginners, it's best to combine these indicators with your local market knowledge. Different regions and property types can behave differently in the cycle. Asian American investors often find success by focusing on growing cities with strong job markets and demographic trends. Connecting with community professionals and local experts can give you early access to important information. In short, keep an eye on vacancy rates, rental trends, construction activity, absorption rates, economic health, interest rates, and property prices. Using these signals together will help you understand where the market is in its cycle and make smarter investment choices. Remember, understanding these indicators is your best tool for navigating the ups and downs of real estate markets.